What are the common mistakes made by investors while selecting mutual funds? If you are someone who is looking to invest in the equity market via the mutual fund route, then you also need to be aware of what are the common mistakes done by investors today. And those mistakes are very similar to direct stock investing as well. But by knowing these mistakes, by knowing the mistakes which today's investors do while investing in the mutual funds, you can be aware of these mistakes and take corrective actions yourself. You can be wiser than the rest of the crowd. While checking in ChatGPT, I entered in ChatGPT how many investors have exited the market in January 2025. As you know, in the previous 3 years, the returns have been good enough, and a lot of people are talking about recession aega. So we're expecting the markets to be in a lull period. So a lot of investors, almost 60 lakh investors, have exited their mutual fund units in January 2025. Why? Now you may be thinking that mutual fund industry is growing. Yes, they are growing. But there have been investors who have exited, there have been investors who have entered as well in the same period of time. So net to net, there is a small percentage of people who have actually got added in the mutual fund industry. So keeping that industry growth aside, we know a sizable portion of the investors actually are exiting the market. So let us see the top three reasons why investors actually exit the mutual fund investing portfolios. So the top reason, the first reason is every investor mostly relies on the past performance of the mutual fund. Now, the past performance could be as high as even 50%, or it could be as low as 6%. Now, if it is as low as 6%, the mutual fund investor might decide, oh, it is giving 6%, so I will not invest in that mutual fund. Or it is giving 50%, so let me get into that mutual fund. Wow, I can expect in the next year, I can expect 50% return. Well, you are in for a disaster. A lot of investors commit this mistake. There have been a book, especially on Peter Lynch managed fund. Peter Lynch, one of the most famous investors, who had been handling his own fund of mutual fund, basically mutual fund collection of companies, and that fund managed to give a return of 30% year on year. 30%, can you imagine? But majority of the investors who have invested in that fund have got negligible to negative returns. Why so? Well, it was realized later that the investors who actually got negative to low returns, especially in the fund which actually managed to give 30% returns year on year over a long haul of at least of about 10 to 13 years, they realized that these investors who have made negligible to negative, they entered that mutual fund portfolio, they started investing in that mutual fund when the returns were at peak. They checked the previous year's performance, oh, it's peaked, let me enter. And in subsequent years, they're up for a disaster and then they exit all positions. So, what do you expect? You expect negative returns. The same behavior, the same emotional behavior is being done even today in the markets. Now, human beings are very rational in most of the cases, but when it comes to investing, when it comes to their picking up of mutual fund or stocks, we are very emotional human beings. So when we see the value going up, we tend to run after it, and when the value goes down, we tend to run away from it. In fact, it should be the reverse. So this is the top reason why mutual fund investors ruin their participation in the bull run by exiting the mutual fund units. So now by remaining investors, we entrust our capital to the mutual fund manager. That's the whole reason, right? We don't want to do the investing. We want to rely on the fund manager to do the work. So hence, why bothered about the market? The fund manager will be bothered about what happens in the market and take the corrective decision. If you have selected the right mutual fund under the right AMC, then of course there are professionals who are managing those funds. They will do the right thing with your money. So that was the top reason, relying on the past behavior, relying on the previous performance of the mutual fund. The second most common thing or common mistake made by investors is that they over diversify in investing in mutual funds as well. Why over diversify for mutual fund? At the most, you can expect to have 5 mutual fund across various asset classes. Now, well, we are emotional human beings. We hear from friends, friend one, friend two, brothers, sisters. We hear from cousins. We hear from uncle. We hear from other friends around, close friends. We see the performance. The friends say, "Hey, there's a wonderful mutual fund," and then we go ahead and buy this mutual fund. And then we end up with an over diversified portfolio of mutual fund, which is almost like 20 mutual fund. 40 mutual funds in some cases. I have seen 30 mutual fund at least invested by a specific retail investor. Can you believe it? Now, we need to realize that mutual fund is a collection of stocks. Now, if you invest in a large cap HDFC mutual fund, and if you invest even in an ICICI large cap mutual fund, you need to also check what is the portfolio allocation for both of them. If the portfolio selection of both of them, the set of companies with these specific mutual funds are managing are the same, then there's no point, right? You're still participating if you just be invested with HDFC or ICICI large cap. It really doesn't matter. So over diversification is another common mistake made by retail investors. So let us see now the third common mistake made by investors. The third common mistake, my friend, is we expect consistent returns year on year. That means we hear from the channel, we hear from the internet, we hear from newspaper, we hear from our financial planners as well, saying that we can expect 12% return average in the equity investing of true mutual funds. 12% average. Now what the investors start thinking is that, wow, that's 12% every year. This is the first year, I need to grow my money by 12%. In the subsequent year, 12%. In the second year, 12%. In the third year. Well, that's not the way the markets actually work. Now, let me put up on my screen some trend line related information. So it's going to help you visualize, it's going to showcase to you what is the performance of the Nifty index. The Nifty index, how did it perform in every year? So let us see on the screen. So if you see on the screen, you see from 2025, in year 2025, we got an annual return as of now of 2.92%. In the previous year, it was 8.8%. And then previous to that, 2023, it was 20.03%. 2022, it was 4.33%. And subsequently, you can just see all the previous years up to like 2017. We have a return of about 28.65%. So in the previous 8 years, the highest performing year was actually 2017, wherein we got a return of 28.65%. And the least performing year Let us exclude 2025 because this year is yet to complete. In the least performing year, we have 2018, which is 3.15%. And across various months, the return percentage varies so erratically. I mean, there is no consistent behavior. But now, if you average the returns over the past 8 years, that means from 2017 to now, we have an average returns of about 14%. But if you average out the, not average, average out, average out the return for the previous 3 years, that comes to about maybe roughly slightly touching 10%. So that's how the returns work over a period of time. So let's come back and reiterate. Let us see what are the top 3 reasons once again. So the first reason, as we said, was relying too much on the past performance, relying too much on the past data of the mutual fund returns. That is the first reason, that is the first common mistake made by mutual fund investors. The second common mistake made by retail investors is that they over diversify their mutual fund portfolios. And the third is we expect consistent return, as we have heard on the channel on the internet, every year on year, मुझे वही रिटर्न आना चाहिए, otherwise I will exit. So you shouldn't be doing these mistakes if you want to enter the mutual fund industry. If you want to start investing in the mutual funds, then you should be avoiding these 3 mistakes. Do read my book on investing. It's more about how you can pick up direct stocks. It also gives some suggestion of an alternate approach other than direct stocks. And the stocks which I have suggested in the book, that is Dodge the Recession, is more on investing altogether. It shows you what kind of portfolio allocation you need to have. So definitely it's going to be of help. It's a very easy to read language. It's a very easy to follow process which you can follow any year, any time of your career. You can read the book, and if you have any questions on the book, please reach out to me.